Hello everybody, this is AK. I'm back. So this is a bonus video. I made another video earlier this morning, in fact very early in the morning, because I was planning to spend the entire day out at sea as the Halloween event just started in World of Warships. And so there will be another video at 8 p.m. which is the regular time slot for my videos. Do come back later to check that out, right? So this bonus video, we will be covering some breaking news, right? And the breaking news number one, T-bill auction, right? The T-bill auction that happened today, the results just came out hot from the oven. Very happy. 3.95% per annum cutoff yield, right? Which is a bit higher than the cutoff yield for the last auction, which I think, if I remember correctly, was 3.87%. Let me just check. Yeah, it was 3.87% in the last auction. So this 3.95%. There's some sanity in this auction, because you see the average yield on screen. You see a screen capture, right? The average yield is 3.6%, which means the lowest bidder bidded like 2.6% per annum, right? Which is a more reasonable bid, right? Since the CPF pays 2.5% per annum, CPF OA, right? So T-bill auction results 3.95% per annum. I'm quite happy because I strengthened my T-bill ladder with this auction again, as I injected some fresh funds in. So I used money that came back from a matured T-bill and put in some more funds, so I'm getting 3.95%. And of course, we know that since T-bills pay us the interest in inverted commas upfront, the effective interest rate is actually more than 3.95% per annum, right? So I still believe in maintaining my T-bill ladder, as the front end of the yield curve is still rather rewarding, right? And this T-bill ladder would serve as another war chest, and can be dismantled gradually when Mr. Market goes into depression, so that I can buy more stocks cheaply from Mr. Market, right? So that's the T-bill auction results. Second thing to talk about, EC World REIT. A long-time reader of my blog and now videos, viewers of my videos, will remember that I made videos about EC World REIT, and also I blog about it, and why I wasn't interested, right, when it first came out. And I also made a video on how to avoid REITs like EC World REIT, right? Not to invest money, invest in these REITs. And I said a long time ago, when I was investing in Sizen REIT, right, that sometimes we have to take NAV with a pinch of salt, because it is valuation made by some third party, and whether that valuation can be is actually trustworthy, right? And I say the best kind of test is to put it out in the market and see if someone's willing to pay that kind of price for that property, right? If it's valued at $1 million and you put it out in the market and you ask for $1 million and nobody wants to pay that price, chances are the valuation was too optimistic, right? Too optimistic. And for Sizen REIT's case, remember they had to pay off some of their loans in order to satisfy their lenders. And when they tried to sell their apartment buildings, they were able to get offers well above book value, right? So they were selling their apartment buildings at like 13%, 16% above valuation, right? Which meant that the valuation, the NAV that we saw in their books was believable, trustworthy, right? And now in EC World's case, EC World REIT, of course we know that they are in trouble. Right now they're in big trouble actually, and they have to sell off some of their buildings in order to satisfy their lenders. But the news just came out that in the Business Times that EC World REIT fails to sell 2 China logistics assets. These assets were bandied around as being very strong assets, right? Because EC World REIT had links with internet company Alibaba, right? So now we see that actually the NAV might not be as trustworthy as we thought, right? So NAV, take it with a pinch of salt. Sometimes we like to buy REITs simply because it's trading at below its NAV and we think that we're getting a good deal. But we don't know, right, until we try selling the asset in the open market, whether the NAV is believable, is trustworthy, right? So third piece of news, UOB, right? So UOB's profit dipped, right, by and it's 1% lower year on year. So its profit in Q3 went down 1% year on year to $1.4 billion. Right, so I think I don't think that the price of UOB shares going down today has to do a lot with that. I think just market sentiment. All three banks saw their share prices dipped, and UOB's performance came in as a bit under expectation, right below expectation, is because of the cost of integrating Citigroup's businesses, consumer businesses in 4 Southeast Asian countries, right? And that kind of cost is, of course, a one-time cost. Right, so once the businesses in the consumer businesses in those 4 Southeast Asian countries are successfully integrated with UOBs, that cost will go away. Right, so like was reported in the news, right? If you remember, last year UOB acquired Citigroup's consumer business in 4 Southeast Asian markets for about 5 billion Singapore dollars. Right, so this, when completed, the move will double its retail customer base in these markets, right? And of course, not all the cost is a one-time cost, which this Citigroup integration cost is. There's also some costs that we have to be more worried about, and that is whether they are going to make more provisions, make more allowances for other kind of losses. All right, and that's because of the uncertain economic situation and geopolitical risk. So UOB has been prudent to put aside more money to make more allowances, and this could increase. But other than that, UOB seems to be quite sanguine, and they're quite optimistic about 2024. And they think that net interest margin, which actually increased year on year from 1.95% to 2.09% net interest margin, they think that next year will be a better year than this year, right? Barring unexpected circumstances. They're expecting growth of mid-single digit growth for loans and double-digit growth for fees, right, for next year. So that seems to be quite sanguine, right? And the last piece of news is Elon Musk lost $28 billion. Yeah, Elon Musk lost $28 billion because Tesla's results missed estimates, right, and underperform, and on both revenue and profits or earnings. So its stock price sank, and Elon Musk lost $28 billion. But remember, that's on paper. That's on paper, right? But I want to bring up another point, and that is, right, if we're 100% in Tesla, our portfolio is 100% in just one stock, and that's Tesla, or almost 100% in Tesla, then we will probably feel the pain more than Elon Musk, and probably Elon Musk doesn't even feel any pain, right? And so there's, if we're very rich, then okay lah, maybe it's just the paper loss is no big deal, that kind of thing, right? But then if we are someone whom are, we are close to retirement, or we're in our or we are already retired, if we are invested in stocks like this that do not pay a dividend, and we need to liquidate in order to fund our retirement or get some spending money, then it might be a bit of a problem, right? So there is a lesson here, and that is not to be 100% in a single stock, especially not 100% in a supposedly growth stock that doesn't pay a dividend, right? And we shouldn't just blindly follow gurus in inverted commas, right? Just because they're 100% in one stock doesn't mean that we should do it too, right? Depends on our circumstances. Okay, so this is the bonus video. There'll be one more coming up at 8 p.m. Till then, bye bye.